very happy Thanksgiving holiday. My name is Rafi, this is Roland, Nazim, Alex, Sevon, and Arten, and today we'll be presenting Microsoft on our firm valuation project. The agenda for today, Arten will be talking about the company history, Alex will be talking to you guys about the recent performance. I'll be going over the pro forma, discounted cash flow, and our valuation from there, along with our weighted average cost of capital with the assumptions. Roland will be talking about the sensitivity analysis. Nazim will be going over our comparable analysis. Sevon will be talking about the dividend discount model, and I'll be going over the final recommendation. So we go ahead and pass it along to Arten.
So the company, Microsoft, was founded in 1975 by Bill Gates and Paul Allen, and it's in the S&P 500 index with a market cap of $1.117 trillion. And its current market price right now for the stock is $149.50, the Dow from last Friday, November 22nd. And Microsoft creates, licenses, and supports a scope of programming items, administration, and gadgets. The company's components include efficiency, business development, personal computing, and focuses on intelligent cloud. Microsoft is the biggest company, that's why it has the biggest market cap. Microsoft also produces and manufactures items including tablets, personal computers, smart devices, and also entertainment gadgets. It offers a variety of services that supports customers with consulting services and solution thinking. Just go over to the next slide. The acquisition history for Microsoft includes LinkedIn, which is at $26.2 billion, Skype at $8.5 billion, and GitHub at $7.5 billion. And the reason why it's good for Microsoft going with LinkedIn or LinkedIn going with Microsoft is that Microsoft CRM is a customer relationship management software package, and it also helps the LinkedIn salespeople to drive up sales, and that's pretty much it.
So in terms of Microsoft recent performance, October 25th this year, Microsoft struck a deal with the Pentagon for a $10 billion contract over 10 years, which for its cloud solution, Azure. So they'd be working together for the next 10 years and providing the Pentagon with storing their information on their cloud, Azure. September of this year, they bought back $40 billion worth of stock, which can do a number of different things for the company. Number one, it could boost their EPS, because it's going to be taking shares off the market. Number two, it thinks that the shares are undervalued and it could boost the stock price. And lastly, it could consolidate ownership in the company. They made a $1 billion investment in a AI company called OpenAI. It's in Silicon Valley, and the collaboration between OpenAI and Microsoft is that OpenAI will be helping implement AI to their cloud service, Azure. And AT&T and Microsoft are working towards 5G this year, so that's the new big thing, new big project. This chart represents Microsoft performance in terms of a percentage over the past 3 years, and we got this off Bloomberg Terminal.
For our pro forma, which is our forecasted financial statements, our main assumption would be our revenue growth, which was at a 14% for both 2018 and 2019. We maintained this growth going into 2020, our first year, and then gradually declined towards a 3% perpetuity rate at the end of the fifth forecasted year. Now, our EPS shows right here that it's been growing as part of these estimates. We baked these assumptions into our analysis based off the recent things that Alec had just noted, and which is that Azure growing, showing a 63% growth rate, and commercial bookings rising for 35%, cited from the Bloomberg Intelligence report and mentioned in their earnings call. Now, from our pro forma, we discovered that our assets are quite significantly high, and therefore we had to implement a $6 billion revolving line of credit as a debt plug into year one, and it progressively increased over time. For our discounted cash flow method, we then we did our EBITDA reconciliation, found our NOPAT, adjusted the NOPAT based off cash flow adjustments, and got down to our free operating cash flow. and then subtracted out our cash from investing activities to fund our cash flow, free cash flow, unlevered free cash flow. Now, as you can see, we use two approaches: perpetuity approach and exit EBITDA multiple approach. These were derived from the values of this unlevered free cash flow. And so in the perpetuity approach, we used the long-term growth rate of 3% and brought it all the way down, used discounting back to present value, and developed an enterprise value of $744 billion. Then using our exit EBITDA multiple approach, our input for that was the terminal value EBITDA multiple that was derived from the average of the comparable companies that we'll be talking about later, which ended up being at 17.95 times, which is rounding up to 18 times. And doing the same type of approach, bringing all of our cash flows to present value using this multiple, we then found an enterprise value of $1.1 trillion. So then that brings us to our valuation using the discounted cash flows. And so using both the perpetuity and EBITDA method, we then made all of our assumptions and then brought it down to our intrinsic value per share, which for the perpetuity method is going to be $105.43 per share, and the EBITDA multiple method, $158.25, with a market premium for the perpetuity method of 41.8% and a discount for the EBITDA method at 5.5%. Now the EBITDA multiple is a little bit higher than our Microsoft multiple, and that's because we do have certain competitors that might be driving up this multiple, which we'll be talking about further in the presentation. Next is our weighted average cost of capital assumptions. And as you can see, we have our cost of debt, which we took a look at the 10K financial report and looked at their debt schedule, and we ended up having a cost of debt of 2.1%. Our tax rate is derived from the corporate tax rate, currently at 21%, which makes our after-tax cost of debt 1.7%. Our risk-free rate was derived from the 10-year Treasury bond rate as of the same time last Friday. And our beta was derived from Yahoo Finance, which they do a comparison to a 3-year monthly against the S&P, and we ended up having a 1.23 beta. Our market risk premium sits at 7%, given that we do have a high beta against the market, but the dispensability and high market cap leads us to believe that our market risk premium should be at 7%, bringing our cost of equity to 10.4%. As you can see here, we also have our weights, 94% for equity, 5.94% for debt, brings us to our weighted average cost of capital at 9.84%.
Alright, so next we'll be looking at the sensitivity analysis. First we have the perpetuity method. So as you can see, we have our base price here, which we got was $105.43, and it's comparing the growth rate and the WACC. So the WACC that the growth rate that we decided to go on was 3%, and we didn't want to move it by too much, so we only did it by 50 basis points. So that's why we have 4%. And then for the WACC, we decided to go on 100 basis points because we felt WACC was more flexible. So we decided to do that, and as you can see here, we have the different ranges. So we have a ranges from $77.39 at our lowest, and then our highest at $176.94. So for the exit EBITDA method, we have the 18 times multiple method, and how we got that method, that number, was basically we looked at Apple's, Microsoft's, Amazon, and Google. And we took the average of those to get the multiple method, and we used that multiple method, and we moved it by 1 times for the increased and decreased by 1 times to get those scenarios. And then for the WACC, we did the same thing as before, 100 basis points to find the sensitivity. And we have a range from $134.12 at our lowest price to $185.92.
So taking a look at the comparable analysis, we decided to go with our direct competitor as Apple. We based that off their market cap size, and them being pretty similar in business. We do offer a lot of products that they offer, so it was something that we thought was that matched well together. We chose not to go with the market average because a lot of tech companies have high PE ratios, and they vary a lot, so it's hard to average that out. An example is Amazon, they have a 77 times PE ratio. If we were to add that into our calculating our intrinsic value, it would not add up properly. So we decided to go with our direct competitor as Apple. So as we take a look, the current stock price as of last Friday's closing date was $149.54. We used Apple's trailing 12 months PE ratio, which was approximately 22.09, and we went with Microsoft's the PE ratio for Apple was 22.09, and Microsoft's forward earnings per share was $6.05. So you multiply the two to come up with an intrinsic value of $133.74, which put it at an 11.8% premium trading price. We thought it was a pretty accurate analysis, seeing as the companies are both over $1 trillion and they're both pretty similar companies. So we did find the comparable analysis to be pretty good to use.
Awesome. So for our final valuation method, we use the dividend discount model. Now, what the dividend discount model is the total sum of all future dividends that are being paid out by the company. So once, in theory, once all of these values are totaled up, you'll get an accurate valuation of the company. However, for Microsoft specifically, this isn't the case. Microsoft, since they had a stock buyback, dividend discount model doesn't take that into account. As well as most of their actual stock growth has been derived from appreciation of the actual stock. We had some assumptions here about the perpetual growth at 3%. We took a 10-year period from 2009 to 2019 of dividends, and we got the 14.9% dividend growth. We also have an expected return of 10.38%. So after we went ahead and calculated the model, we got a 243% premium. The price estimate was $61.45, which is well above what it's currently trading at. But again, we have to take all the factors into assumption. Rafi is going to go more into detail about that.
Sure. So as our final recommendation, we took a look at all of our different valuation methods. We discovered that the DCF, discounted cash flow perpetuity method, would be the most accurate method, given that we were able to bake into our analysis certain different factors, and it's a little bit more complex, so we can determine a better valuation for the stock. Our DCF EBITDA method, as we cited before, the certain comparables and the enterprise value to EBITDA for these different companies kind of brings up that multiple a little bit higher, so therefore that was the one that we had that discount, the discounted share price at, so it wouldn't be as accurate. Our comps analysis would be around that same kind of reasoning, that there's a little bit of different multiples there, and the forward EPS would not be an accurate measure. Our DDM, as Sevan just cited, we're paying a pretty low dividend relative to our stock price, and wouldn't be an accurate measure for the intrinsic value of the stock. So finally, we have decided to go with our perpetuity method, and we're issuing a sell rating based off the market premium of the stock. Thank you guys so much.